Good afternoon. Welcome, everybody. We are broadcasting today live from outside of Tampa. And Bob, where are you?
Bob?
I'm in New Jersey right now.
New Jersey. And Don?
I'm in New York in Rockland County.
Rockland County. So we are delighted to have Bob and Don with us today. And all of you are so welcome to be here, and also welcome to ask questions as we go along. And thank you again for spending a bit of your afternoon with us. The Family Office Insights community has been awesome through this whole change of life and pandemic, and been super supportive of Family Office Insights and the companies that we host. So we just want to thank you again for that, and thank you for spending your time with us this afternoon. The Zoom housekeeping, just as most of you know, we can't hear or see you, but you're so welcome to ask questions in the Q&A or the chat box. And we have a lot of people coming on this afternoon, so please feel free to ask them, and we'll get to as many as possible. And don't be afraid to ask anything, and you can ask it as we go along and we'll get to them. For the record, this is being recorded. If there's anybody that you know or in your community or colleagues that would benefit from hearing about it afterwards, you're certainly welcome to share the link that'll be on the Family Office Insights YouTube channel. And also we'll put you in direct contact with Bob and Don, so you can dig a little deeper if you care to, or share it with others. So we've got about a half hour today, and so we're going to get to the meat of the matter. First, I'm going to introduce Robert.Krause, Bob, and have him do a little background, and Don's going to do his, and then we'll get into the formal presentation. So thanks again for everybody for being with us today and spending your time. It's all yours, Bob. Welcome.
Oh, thank you, Art. Yeah, and thanks for hosting this event. You know, it's really great. We have a real treat for you today. This is a large-scale fintech project that we think could change the largest industry in the world. So you just need to go to demandderivatives.com if you want to get more information. But just a little quick background on me. I've been in this industry for over 30 years. And in fact, everybody that works with me has been at least 30 years in the business as well. And I'm joined today with Don Schlesinger. He's the president. I'm the CEO. And Don, you want to say a few words?
Sure. Great to be here. Thank you, everybody, for coming. I began my career at Morgan Stanley in 1984 as a proprietary trader in the institutional equity division, trading options and futures and over-the-counter derivative products. After about 10 years on the trading desk, I was named the head of global equity derivatives training and education. And as such, I delivered seminars and conferences on risk management and derivative products quite literally all over the world. After I retired from Morgan Stanley, I continued to consult for them and other Wall Street firms, doing conferences for a number of years. And then it was my pleasure to join up with Bob at Demand Derivatives. So that brings us to today.
Okay, great. Arthur, does everybody see my screen now?
Yep, you're in good shape.
Okay, great. All right, so let's begin. So, you know, Warren Buffett said that derivatives are weapons of financial mass destruction. But we know that markets are not bad per se. How would a farmer sell his crops if there were no markets? What then is the problem? Could it be that the way the contract was designed? In the US, futures contracts design dates back to 1848, more than 170 years ago. The exchanges have fixed and patched the current design for generations, and the industry has painted itself into a corner. Industry leaders continually meet year after year, meeting after meeting. They still have not come up with the perfect answer to the question, what is the proper margin to cover the risk of defaults? The reason is because there is no correct answer. There is no perfect amount of margin that will cover all defaults. In 1987, the stock market crashed. In 1998, long-term capital management stressed the financial system. In 2008, Bear Stearns collapsed, and so did Lehman Brothers. In 2010, the flash crash showed how vulnerable markets were to automated trading. In 2018, the volatility tsunami caused negative segregated balances at 2 large brokerage firms. That's not supposed to happen, by the way. And in 2019, a lone trader in Norway shook the financial system, almost causing a collapse in an exchange there. And that collapse would have reverberated around the world. Stresses were felt in 2020 when COVID was unleashed. And in April of last year, negative crude oil prices jarred our understanding of what zero means. We even had a trader who started the day with $77,000, and within a few hours he lost 9 million. If a negative 237% move were to happen in bonds or the S&P, the financial world as we know it would end. There is no margin amount that could cover such losses. Perhaps what is needed is a whole new instrument, one with a completely redesigned engine. Our solution has 4 new derivative instrument designs. Current exchanges have 2 instruments, futures and options. We have 4 called Real Vol, Real Day, Real Globe, and Real Limit. Welcome to Demand Derivatives, a revolutionary futures exchange and clearinghouse, trading the world's major assets in a creative new way. We will launch our new instruments on the top 6 assets: gold and metals, 10-year in rates, corn and agriculture, euro in foreign exchange, the S&P and equity indices, and crude oil and energy. By the way, we're not expecting to trade cryptocurrencies. By last count, there were 430 crypto exchanges. We're not interested in competing with hundreds of exchanges, but we are interested in breaking through the near monopoly currently enjoyed by the CME group. The exchange will be named Real Demand Board of Trade, or RealBot for short. The vertically integrated clearinghouse will be Real Demand Clearing, or RealClear.
Real Vol is a realized volatility instrument. Instead of trading direction, traders can now trade risk itself. This is a watershed product for the advancement of risk management. Real Day is a true daily option. It has market exposure for exactly 1 day, perfect for traders to profit from a known event, such as an election, a Fed meeting, earnings releases, or a Supreme Court ruling. Real Globe is a world index exchange. This product will compete with all exchanges in the world. Real Limit is a limited risk futures contract. This is our flagship product that can disrupt the industry. Let's dive into some details. Here is a chart of a long futures position. During normal markets, the margin collected covers the risk of loss. When market moves are greater, excessive losses can occur. Traders' losses are not constrained to the margin amount collected. If moves are very large, individual defaults may result. And if losses continue to mount, system-wide failures are possible. In such a case, defaults don't just affect the losing side. the winning side may not get paid either, resulting in both sides essentially losing. There is a better way, a way that no matter what happens in the world, our exchange will be able to pay winners, and the trader on the losing side has the loss constrained to predefined and manageable levels. The solution is a product known as Real Limit, a limited risk futures contract. These fully margined, fully collateralized instruments mean that defaults are impossible and the financial system cannot be put at risk. In addition, users will be able to select the amount of margin they put at risk, meaning that they completely control downside losses as well as upside potential. Here is a quick example. If a trader buys a real limit contract and the price remains within the boundary limits, nothing unique happens. The contract performs just like a standard futures contract. If the price touches the upper boundary limit, the contract goes through a process we call early expiration. The long receives the maximum gain, and the short loses all posted margin. If the price falls and a lower boundary limit is touched, the contract expires early with a maximum loss for the long and maximum gain for the short. Notice that even in a crash or gap scenario, the contract still gets liquidated at the maximum gain for the seller and maximum loss for the buyer, in this case at 970. Finally, we wanted to show how a trader can get essentially unlimited upside potential through what we call the real roll process. By executing a real roll prior to a boundary price breach, the trader can change or recenter the boundary prices. Suppose the market moved up to 1025. The trader enters a real roll order, and after getting filled, he gets $2,500 in his account, and new boundary prices are set at 995 and 1055. If the trader is diligent about rolling every time before touching a boundary price, the position in effect achieves unlimited upside potential.
By limiting the risk, we eliminate the need for credit. With no credit extended, the fully collateralized clearing process is vastly simpler and much less costly to implement, allowing us to pass on those cost savings to traders. This provides us with a large fee advantage against competitors and still leaves the exchange a healthy potential profit margin. Cost savings are not just from reduced fees. This table shows some of the savings that traders can get from more efficient contract design and a reduction in the number of transactions. Real vol futures can save traders the high cost of transactions instead of delta hedging a straddle. Real day options are priced for 1 day, potentially reducing the premium as compared to getting such exposure with weekly options. And Real Globe has 9 new features that can reduce the number of transactions required by 98%, making global equity index exposure nearly free as compared to other exchanges. In phase 1, we will launch Real Limit, Real Vol, and Real Day on the top 6 assets, which are highlighted in yellow. This is the low-hanging fruit, so to speak. There are millions of traders trading these assets all around the world. All we need to do is show them our unique risk-reward profiles that CME does not have, our instant clearing, and much lower fees to make inroads into CME's near monopoly. After those products prove to be successful and liquid, our plans include launching on many more assets. The rest of the page shows the full list of the top 40 assets. In phase 2, after our exchange launches, traders are connected. Launches and traders are connected, and there's liquidity. We plan to launch Real Globe. Think of this as the World Index Exchange. We will bring country indices from around the world onto one exchange, providing a truly global liquidity pool. This will be a boon to international portfolio managers.
We have assembled a highly experienced team. Bob was an executive at the CME. He also held senior positions at Morgan Stanley, Zurich Capital Markets, and Mitsui Commodities. Jeremy Johnson was a senior executive at BATS and MIAX Exchanges. Richard Heckinger was the CEO of the Hong Kong Futures Exchange and a former official of the Chicago Fed. I was an executive director at Morgan Stanley and was offered the position of global head of risk management at Deutsche Bank, which I declined. Several years later, I came to work with Demand Derivatives. Wendy Robinson was former counsel at CFTC, NASD, and several investment banks such as Payne Webber and EF Hutton. Andrew Kumiega has a PhD in industrial engineering. He has been designing systems and processes for market makers, hedge funds, and exchanges almost his entire career. He will be our COO. Norm Wattenberger, picture not shown, will be our head of IT and was a team leader at Citibank's strategy and architecture area.
The exchange and its clearinghouse will be regulated by the CFTC. We will also apply for regulatory oversight by the SEC so that we can list futures on securities. Our technology partner is GMEX Group. They will provide the exchange and clearinghouse systems and software, including blockchain clearing. GMEX has many successful installations at exchanges around the world. You can think of them as like an exchange in a box. All of our technology is done and ready to roll. Partners include Box Options Exchange, Bloomberg, Quandl, ICE Data Services, US Bank, the SecDex Exchange, and the Hamilton Stablecoin Project. Fiduciaries such as pension funds and asset managers will be compelled to trade on our exchange precisely because they are required to seek out low risk, low cost providers. Other participants will be drawn towards other features such as arbitrage potential, high leverage, and guaranteed payments. One of the key aspects of an exchange is gathering liquidity. To do so effectively, we have created a comprehensive marketing campaign touching nearly every viable outreach method. We will use professional videos, radio podcasts, strong presence at trade shows, brochures, academic papers, daily social media, email blasts, including online and offline advertising. But most effective may be the teams of people we expect to hire to reach large institutional players for one-on-one meetings. For example, if we could get BlackRock, as an example, to use our exchange, a single order from them could be bigger than 100 Robinhoods. As successful as Robinhood is, it pales in comparison to the amount of capital controlled by the largest institutional traders. Here is our historical and anticipated timeline. You should receive a copy of our pitch deck, so you will be able to study it in more detail at your leisure. For now, let's just focus on a few highlighted yellow items. With initial funding, we will use that money to apply for our regulatory license. This is the key hurdle for us at this stage. In approximately 9 to 12 months after funding, we expect to receive regulatory authorization and then launch the exchange shortly after. Our initial listing will use 3 of our instrument designs on the top 6 major assets for total 18 total products. Then about a year after launch, as liquidity and connections develop, we will launch Real Globe on up to 39 top country indices in the world. Here's a list of key benefits. Other exchanges do not have our instrument designs. All instruments on RealBot have limited risk. Current exchanges all clear overnight, which introduces other risks. Current exchanges do not offer guaranteed payments. We'll have better than AAA credit rating precisely because we have no credit. An internal blockchain will satisfy regulators. Our process encourages top-of-book liquidity. Many order types on exchanges are best efforts. Ours are exact or perfect. We don't need guarantors. In essence, we cut out the middleman. Current exchanges require billions of dollars in reserved collateral waiting for the next crisis. We don't need to determine the correct margin level. Customers choose what works for their risk tolerance. Customers will save between 50 and 90%. Let's compare our industry to the so-called FANG stocks. Each one is approaching $1 billion per day in transaction volume. However, this is dwarfed in comparison to futures trading, which is 10,000 times bigger. The futures industry is stable during normal times. The industry performs well during trying times. The CME has a near monopoly in the US with a 91% market share of futures trading. Because of their near monopoly position, exchanges have the highest profit margins of any business we know, averaging 75%. This is especially striking when compared to other profitable industries such as market data vendors at 33 and investment banks at only 15. Demand derivatives is currently valued at 32 million. The ABAX exchange, they're another startup exchange out of Singapore. They're about 6 months ahead of us in terms of development. We are both pre-revenue, pre-launch. ABAX is nearing regulatory approval now. Demand derivatives is just starting that process. They will focus on liquid natural gas products and gold. So 2 products. And as I mentioned, we have 18 new products scheduled. ABAX is currently valued at 250 million. We are asking only 32. If we compare our exchange to established exchanges, the CBOE is 200 times bigger. This is our target in 5 years. The CME is the gorilla in the room. They command 91% of US futures volume, and as I said before, with a $65 billion market cap. That is 2,000 times bigger than ours. This is our 10-year target.
Hey,
Let's
Bob,
Yeah.
Bob, before you do that real quick, I got a couple questions if that's all right.
Yep.
So I don't want to oversimplify it. I'm paraphrasing a couple questions, but when you are saying that there's no credit risk because there's no margin, and I don't want to oversimplify it, but the downside is protected by the amount of collateral that someone posts to protect the downside to the extent that they're willing to lose that collateral.
Right.
And the upside is served by the performance of the trade.
Okay.
Is that right?
Yes.
So
Yeah. So so let's say that you agreed to post $5,000 for a position, and that then would become, because of the way the contract is designed, that's the most that you can lose. But we then match you with somebody who has equal and opposite exposure to you to keep risk and reward in balance. So that person or the opposite side, the counterparty of your trade, has $5,000 risk as well, meaning that you have $5,000 worth of upside potential.
okay. And then would you Would one argue that the downside protection is how much money am I willing to lose? And if I lose it, I've already posted it, so there's no risk to the financial system, so to speak, because somebody isn't delivering credit and the market crashes, right? And
Correct.
the upside is, I'm paraphrasing a couple questions to suggest that when someone puts a credit trade on or a margin trade, they're doing it so they want to have a multiple of their underlying investment in terms of the upside by borrowing money to do the trade. So that's, you know, the horror happens is when it goes, you know, it goes dramatically down. So how is this different in that they're posting their own collateral, but it's stopped out when that collateral is exhausted?
Yeah, Don, why don't you explain this one?
Well, so what's happening here is when you have a linear product such as a futures contract, it becomes obvious that what you lose, somebody else makes, and vice versa. So we as you just stated, we have that controlled on the downside, but you might be referring to the fact that people enjoy a leveraged return on the upside, and they'd like to cut their losses but allow their gains to run, so to speak. Okay, so this real roll process that I described a little earlier allows the person who might see that he's getting close to that upper limit, where he might be stopped out, where he might bump into a boundary price, to simply recenter his trade and kind of ratchet it higher as he gets closer to the boundary price. So if he's so inclined, he's enjoyed what he's made so far, but he wants to stay in the game a little longer, he enters this roll order. He gets what he's already made, and then he recenters the trade at a higher level, giving him a little breathing room and a little bit more upside. And of course, the downside has moved up as well. Some people in the markets would call that a rolling stop, where you keep on stopping out at higher levels eventually, so that you can't really lose anything on the original trade at all.
And so that brings us to another question from the audience, which is, how is that going to prevent, because, and again, this is very pedestrian, so forgive me, in the event that when we had financial crisis, the downside was so dramatic that even the credit providers exhausted the line of credit, and it ate into their balance sheet because they couldn't trade out of the position soon enough.
Right.
So in that example, I don't know if you can roll back, Bob, but in that example where I spoke about the potential for a gap or a crash, and this is exactly what happened in 1987 with the so-called portfolio insurance, where people were told that they could protect the downside by selling futures at different levels along the way. And nobody told them that sometimes the elevator doesn't stop at all the floors along the way and just goes straight to the bottom all at once and skips all the intermediate points. And by the time the smoke cleared, there was a disaster. But in this particular example, where you see that kind of dropping off a cliff, or a kind of a gap in the prices, our mechanism simply stops out the trade at the boundary at 970. The futures don't stop trading. The market doesn't stop. It goes on. But anybody who has a contract with us and has posted that amount of collateral, in this case, comes in at 1,000, and he posts 30 or $3,000. Once we hit that level, this is what we would call an absolute stop, a perfect execution. This type of a stop order simply doesn't work in a fast market or a gapping market or a crash scenario, because you run through all of these stops. But in our situation, this is exactly what we are protecting against, because the minute you touch that boundary, the position is closed, the collateral is lost for the person who's long, that amount is made by the person who is short, and what the futures do from that point on can in no way affect the participants in our particular market.
Yeah.
And
there's no hanging on hoping that you're going to come back up. You're out.
Yes.
In this case, correct. That's right.
Yes. And one other point you made, Art, about leverage, and let me talk about that. So I tried to make the example here an example very similar to what the CME might have, where they would say, okay, look, you're trading this contract, it has $1,000 price. We're going to put a $3,000 margin on that product. And so in our case, we put up a $3,000 margin. They put up a $3,000 margin. We have the same risk. It looks like the same contract. The only difference is on our exchange, that 3,000 is absolute. That's the most you can lose. On the CME, it's called a best efforts. You know, people put in stops and say, hey, look, the most I can lose on this is 3,000. So I'm going to put a stop. Well, a stop is called best efforts because it's not guaranteed. They try to get you out at as close to 970 as possible. And in a situation like this, where it gaps down to 920, that might be the next best trade. And you just lost 50 points beyond what you thought you were going to lose.
I get it. So, yeah. But why is it different than you? How are you able to get out and they aren't?
Because we redesigned the instrument. And that gets back to that 170-year-old contract design that we opened up the presentation with. The instrument design has a flaw, and they've been trying to patch it for 170 years. And we said, look, let's throw away the engine, start over, and redesign futures from the bottom up to make it limited risk. But then everybody says, well, okay, I like the limited risk feature, but now you're also limiting my upside. And then we said, okay, well, we can fix that drawback of our instrument design by making this roll thing where you can just keep rolling it up as, you know, forever. So we restored the unlimited potential while still giving you limited risk.
And so there's another question on this topic. So what could go wrong on a precipitous crash and it breaks through the lower boundary? The trigger is instant in that you're out of the trade because the trade just got paid off.
Mm-hmm.
Yeah, you're done. There's on our exchange, it would be a non-event. You would just get liquidated. Like if in this example, you would just be liquidated at 970, even though everybody's trading it at 920 now.
So, I mean, that's the thing that's hard to wrap your head around sometime, because the question I saw pop up was, you know, how do we protect against that gap move? Well, you don't protect against the gap move. The rest of the world is seeing that move. The futures continue to trade, but on our exchange, if you had a limit at 970, you simply are out of the trade and you don't participate in any of the movement beyond that point.
So I want to get to a couple more questions and then have you wrap it up, because we're going to run out of time because we have a bunch. There's a thoughtful question here from Mark. I noticed that in some of the promotional material, the stuff that we sent out, invitation, derivatives were credited with the causation for the 2008 global financial crisis. So this Mark has put it more elegantly than I did. How much of the causation was due to the regulated exchange traded derivatives versus unregulated bank derivatives?
Well, I can't answer that specifically, but obviously in 2008, which he correctly brought up, that was more the over-the-counter derivatives, you know, credit default swaps and the mortgage MBS and CLOs and all those kinds of things. But the point is that those are leveraged derivatives. That's the point I'm trying to make, is whether it's on exchange or off the exchange, you know, Lehman Brothers and Bear Stearns blew up because they only had 3% of the collateral for the positions that they had. So this 3% is leveraged 33 times. And so it doesn't take a big move to get rid of that 3% worth of collateral. And the same thing happens on, you know, listed exchanges as well. It's just that there are extra patches that they put into place that kind of mitigate some of that. But like we tried to show you with the crude oil moving minus 237% in one day, there's nothing that they could do to fix that if that happened in a market that wasn't expiring tomorrow. The reason that was contained was because almost everybody left that contract and there were only a few players left. And that one contract that was expiring tomorrow, it affected a few guys, and that's it. But if that were in, you know, the S&P or bonds or, you know, even crude oil in a liquid contract, the world as we know it would not exist today. So what I'm trying to get at is this notion of you know, leverage being the culprit, and we have leverage. See, we're only putting up, let's say in this example, $3,000 for a $300,000 contract, right? There's still leverage here. It's just that you don't, we're guaranteeing you a stop out at your margin level. That's really what we've designed here. We still give you leverage. In fact, we can give you more leverage than the CME. If the CME said, hey, we're going to charge $3,000 for this contract, we can say, okay, well, if you want, you only have to put up $1,000. We can give you 3 times the leverage of the CME. Well, what's the benefit and drawback there? Well, the benefit, obviously, you only have $1,000 worth of risk. The drawback is you only have $1,000 worth of upside. So what we're saying is by you controlling your loss and your gain, if you say, hey, look, I love the fact that you're limiting my risk, but I think this could be a huge move. I think we could go up 10 times. Well, then give us $10,000 on the downside, not, you know, and then we'll give you 10,000 on the upside. But also you could do the same thing with $1,000 risk and just keep rolling it over and over, you know, 10 times to get $10,000 worth of upside.
So we have a 1 or 2 other questions that I'd like to get to, but let's go ahead into the ask.
I'm sorry, get to what?
Yeah.
Oh,
yeah.
Yeah. Hold on.
Super helpful, Buzz.
I think down at number 44, Bob.
Okay. Yep. 43. Okay. Gotcha. Here we are. So our current funding needs are $2 million. With that money, we can get the doors open. In other words, we can get to launch. However, to make that launch successful, we will need another $2 million for marketing and trader incentives. You know, starting a market is kind of like those old-fashioned hand crank propeller engines, you know, where you had to grab a propeller and force it to start. With exchanges, you have to force it to start and then it kind of runs on itself. So where we need the marketing dollars is right up front to force that market to start, to bring everybody there on day one. So $2 million to get the doors open, $2 million to make it successful, and $2 million for a reserve requirement. This is required by the CFTC in order to get your license. That money just goes in the bank to show them that we are collateralized. Shortly after launch, we will go back to the market for round B funding of approximately 20 million. And this money is projected to take us through the ramp up period to sustainability. So that would be the entire funding of the exchange.
So super helpful. Thank you. The thing that most people are thinking about now, I would think, and I don't mean to speak for the audience, is, okay, why would CME let this happen?
Okay, so they certainly know we exist. One of our patents on volatility, they wanted to destroy or wanted to steal, or however you want to
shelf. Yeah.
however you want to couch that. They challenged our patent. It took us about a year to defend it. We won the patent challenge. They didn't like that answer. And a couple months later, we get another 10 pounds of paper in our mailbox. They're challenging the patent again. We went through another year of that process, and we came out victorious again. We won both patent challenges. In a way, they've kind of spent their bullets. You cannot keep, essentially litigating or challenging or,
well, they can try to just outspend you, but that's a whole different issue.
Yeah, we can compete, but they're kind of running out of choices to sort of litigate us out of existence, because there are things about, protecting competitors.
Yeah, very interesting. Are you at liberty to share your patent counsel?
I am very sorry to say, and Don doesn't even know this, our patent counsel has recently died.
Oh, my.
I didn't know that.
Yeah.
Wow. Well, he did a good job anyway, so.
Oh, he did a fabulous job. I am so thrilled with that. But we do have a couple of, counsels kind of waiting in the wings that I'm kind of vetting right now.
So if you care to, and I don't mind saying this in front of the audience because many of them know it, I have a very good friend that is a star. So if you care to know him, I'd be happy to introduce
Yeah, I would love to talk to him.
Thank you.
So this was, I read everything is first of all, I find it interesting. I bought an interest rate swap, and I guess it was 4.5 years ago now. And what was really interesting, and I love the guy, so I'm not going to say anything disparaging, but it took me, a month to understand what was really going on, because I couldn't understand how they would be willing to give me one side of the trade, because they had to be smarter than I was, right? I mean, there's no question that they had to be smarter than I, and it's just math, right? It's like a balloon where you push it in and it goes out the other way, right?
You're supposed to spend that month before you do the trade.
No, I did. But I don't want to say this, but a lot of the guys that are selling those trades have no idea how the trades work. And I needed to understand the ugliness of how the sausage was made, right?
Yeah.
Because I had to wrap my head around it. And it's super fascinating. Anyway.
Yeah,
so,
one of the things that we prided ourselves on and argued over is, okay, we could do it this way, but that's too complicated. How do we make it simpler?
Yeah.
As our whole exchange is based on getting you the simplest, method or strategy or process possible. So everything is as simple as possible. In fact, our process is now simpler than the CMEs. So if you understand CME and all their margin and credit and clearing, and ours is like a piece of cake compared to that.
You think that there's a market for what you're doing in the non-regulated?
That's possible, but our patents are all in the regulated space.
Gotcha. Yeah.
So we want to stick there because that's where we have an edge. And it would be very, very difficult to get a patent in the OTC world, because the OTC world is essentially custom. If you can write it on a piece of paper, then you could do it. Well, that doesn't yield itself to protection from patents very well.
But what's kind of interesting, Arthur, is that one of the products, RealVol, the realized volatility contract, in the over-the-counter space, these are extremely liquid contracts that are traded all over the world, and they refer to them as vol swaps, volatility swaps, or variance swaps. And what we've succeeded in doing, what we will succeed in doing, is quite essentially bringing that product to a listed exchange. What we have now in a volatility product at CBOE is the VIX on implied volatility, but there is no realized volatility product trading on a listed exchange. So we bring the concept of that worldwide liquid over-the-counter volatility swap or variance swap onto our exchange.
super interesting. I did a bunch of research and with some help from smart friends to really understand what implied volatility meant as opposed to what people think it means. Super, super interesting.
Yeah,
So-
and I can sum up the difference in one sentence, which is implied vol has a minus 80% correlation to the underlying asset. Okay, so as vol goes up, the market goes down, or vice versa. Unrealized vol has a 0% correlation to the underlying asset. It's really a very different animal. We share the name volatility, but it's a completely different product. Yeah.
Super cool. Well, this has been great. We're running out of time, and we have a bunch of questions, but you'll see them. We'll send them to you after, and we'll make sure that you can get in touch with everybody here, guys, as well as the audience. We'll put you in touch with Bob and Don, and very, very interesting stuff. We wish you the best, and we'll make sure you can get in touch with the folks here and see if you can.
Okay.
Thanks very much, Arthur. Thank you to everyone who attended. We appreciate your time, and we'd love to hear from you and answer any further questions you might have.
That's awesome.
Absolutely.
Thank you, Brett. And thank you, everybody, for attending today. And as I always say, thank you for spending the only thing you can't make more of, and that's your time. Till next time. Thank you.
Bye-bye.